Hi everyone, this is Mrs. V Chan. Welcome to my Form 5 business lesson number 5. And today is 20th March 2020. Alright, so today we have this chapter, which is chapter 5, working capital management. So what is the meaning of management? Management means how to get things done, right? And how do we use limited resources to maximize outputs, to maximize profit, to achieve our targets efficiently and effectively. And then in this chapter, so we have these resources, so which is working capital. All right, so the first thing we look at what is formula of working capital. So working capital is equal to current assets, right? Remember that, minus all the current liabilities, right? This is working capital. And then let's look at current assets. So can I have all the examples for current assets? Okay, so what do we have? We have inventory. Okay, so what's next? And then we have trade receivable. Right, and trade receivable is same as accounts receivable. Okay, and then which is same as debtors. So debtors here, same as our customers. Okay, we are going to receive money from our customer after making credit sales. All right, so what else do we have? And then we have cash at bank. All right, and lastly, we have cash in hand, right? And then we always start with this order. So which one takes the longest time to be converted into cash, which is inventory. All right, so we always have this order. Okay, now we come to current liabilities. So what do we have for current liabilities? Okay, so which will be trade payable. Okay, and trade payable same as accounts payable. Remember that. And same as we owe money to our creditors, is that right? We owe money to our suppliers after we have made credit purchases. Okay, so in this chapter, we are talking about how should we manage this working capital. So therefore, if you refer to your handouts, okay, so we will have what? We will have cash management. Okay, and then you go to page 3. Okay, so therefore we have accounts receivable management. And then page 4, we have accounts payable management. And finally, so on page 5, we have inventory management. So this is about the idea in this chapter, working capital management. Okay, so here we have cash management, and there are two conditions. One is holding more cash, one is holding less cash. So what about if we hold more cash? That means we don't buy bonds, we don't buy debentures. Therefore, what do we forego? We forego interest income from buying bonds and debentures. Therefore, we forego more interest income. So what happened to opportunity cost in that case? So we will suffer from higher opportunity costs. So this is a situation if we hold more cash. All right, so what about if we don't hold enough cash? So even though opportunity costs will be lower, however, what happens? So we may not have enough cash to pay all the expenses. Okay, for example, we need to pay rent, we need to pay salaries to the employees. So therefore, what is the golden rule for cash management? So you go to your handouts. So here, point number 2, we have this basic goal of cash management. So make sure that we have adequate. So what is adequate? Same as enough, same as sufficient cash for business operations because we need to pay expenses, and at the same time not to hold too much cash to minimize the amounts of idle cash, means not using the cash. Otherwise we forego too much opportunity cost so that the costs of holding cash is minimized. So this is the meaning and the rule for cash management. Okay, let us plan ahead and make sure that we have enough cash to run the business, but at the same time, not holding too much cash as in order to minimize the cost of holding cash. So here we look forward we have our cash budgeting, and also there is an assumption and saying that this 144,000 will be the minimum cash that we need to pay for expenses in order to run our business. Okay, so that we start with this total cash receipts. So we may have cash received from cash sales, right? We may have cash received from debtors. And next, minus total cash disbursements. So this will be the cash that we need to pay for expenses, for example, for salaries, for wages, electricity, so that here we get the net cash flow. So I use my calculator, so 540 minus 324. So this is 216. Okay. All right, and here we add the beginning cash balance. All right, so this is, and so therefore we will have this plus 90. Okay, so that will be 306. Okay, and then we need to compare the minimum cash for running the business. So I minus 144. Okay, so what about in the first quarter? So we can have 162. So we get cash surplus so that we can think about something else to do if we have cash surplus. Okay, so next we come to the second quarter. So we have cash received, which is 450, and then minus 414, so that I have this net cash flow 36. Okay, so what about this beginning cash balance? Actually, the beginning cash balance will be the closing balance in the first quarter. So I put 306 here. So 36 plus 306. Therefore, I get 342. And minus the assumption, 144. So 198. So therefore, in the second quarter, we get another cash surplus. Okay, let's do it in the third quarter. 270 minus 504. Oh, however, we use the bracket for net cash outflow, which is negative 234. Okay, and what about the beginning? The beginning will be last year's closing. So I put this 342. Oh, like that. So plus 342. So 108. Okay, and then 108 minus this 144. So therefore, we use a bracket for deficiency 36. So we will have deficiency, okay, in the third quarter. Okay, so the last quarter, we repeat that. So 270 minus 216, so which is 54. Okay, and the beginning, okay, which is the closing last quarter. So I put 108 here. So 54 plus 108, so 160, and then minus 144. So that 18 will be the cash surplus, which is positive in the last quarter. Okay, so after we have completed the cash budgeting, we get these two results. One is cash surplus, one is cash deficiency. So what about if we have cash surplus? That means we can think about investments. We can buy bonds to earn interest. We can buy shares to earn dividend. All right, so to get the return. So because it is not necessary to hold more cash than needed, otherwise we will have too high the opportunity costs. Now the opposite. So what about if we do not have enough cash? Therefore, we need to think about financing. So what is financing? You go back to chapter 3, we have sources of financing because we always need enough cash to pay unexpected expenses. Okay, so what is the best way to handle cash management? We can do this. Accelerating cash inflows. That means you speed up cash inflows. You can just go to your debtors to ask them to pay you earlier. Maybe you can give them some incentives like discount allowed. And what else can you do? You can delay cash outflows. Let's say you pay your creditors later and make sure that you have your cash inflows come before cash outflows. So you synchronize these two actions to make sure that you have enough cash to pay expenses and at the same time not holding too much cash. Okay, now we come to accounts receivable management, which is same as trade receivable, same as debtors. So why we have that? Because sometimes we allow customers to pay us money later after making sales, so we have this credit sales. And then two conditions, longer credit term and shorter credit term. Okay, what do you think? Which one can make more sales? Which one will be more attractive to customers, of course the one with longer credit terms. Therefore, if we allow longer credit term, we will get more sales, right? Because the customer pay us later, so what do you think about the risk of bad debt written off? That means we may have customers fail to pay us money, so therefore we may have higher risk, and this is no good. All right, and next, shorter credit term, so which is not that attractive to customers. So in this case, we may make less sales, and at the same time we have lower risk of bad debt written off because we have shorter credit term. So therefore, we have to strike a balance between this to make it best for accounts receivable management. So how long should be the credit term? All right. Okay, now we come to details of this accounts receivable management, and also we have these elements of credit policies, and there are 3 elements. We have credit standards, credit terms, and collection policy. All right, we are not sure whether we should grant credit sales to our customer, so that we need to assess customers' credit worthiness to make sure that, okay, the customer will pay back us money. All right, so we call that 5 C's. Okay, which 5? So we have character, the reputation of the customer. We have capacity, so whether the customer has money to pay us back. We have capital, and then we have collateral, and then we have conditions. Okay, so anyway, I will give you the detail in the next video when we go through DSE question. Okay, so next we have accounts payable management. An account payable is same as trade payable, same as creditors, and which is also current liabilities in the statement of financial position. Okay, so therefore we have these 2 conditions. So after making credit purchases, we can settle earlier. That means we pay money earlier to our supplier, or we don't pay money earlier, we pay later. So what happens if we settle money earlier? So therefore, what can we enjoy? We can enjoy a kind of discounts, and this discount must be a kind of cash discounts, but not trade discounts. So we do some revision on that. Okay, all right, and let's also look at the double entry to do some revision. All right, so to settle earlier, that means we need to pay money, so we credit bank, and then we pay money to supplier, we pay money to creditor, so therefore we have less liability, so we debit we debit trade payable. Okay, so for example, what about if we owe 1,000 to creditors here? However, since we pay earlier, we only pay 800. So what do you think? Therefore, we need to insert this 200 here, and then credit, and what do we enjoy? And then we will have discounts received from creditor. Okay, so this is the situation that we can enjoy if we settle earlier. That means if we pay earlier to our creditors. Okay, so the opposite. So what about if we don't pay earlier? We keep our money. All right, pay later. So we say that this is kind of financing. So sources financing in chapter 3, which kind of that? Which is a kind of short-term financing. And remember the term, we call that trade credits. Right, so if you refer to chapter 3, sources financing, you will have one of the examples, which is trade credits, which is exactly about the things that we can enjoy if we pay to supplier later. So this is about accounts payable management. Okay, so after accounts payable management, so we come to the final thing in this chapter, which is inventory management, and then I will make another video to explain to you what is inventory management. So thank you for watching my video. I will see you next time. Bye bye.